Before the concept of money existed, there was barter, a system where people exchanged goods and services directly. If a farmer had wheat but needed milk, he'd trade with someone who had a cow. Simple, right? But not always efficient. What if the person with milk didn't want wheat?
No.
Or what if the value of the goods wasn't equal?
Hi, dude, want to exchange?
These limitations made trade difficult on a larger scale. Barter worked, but only within small communities, and when both parties needed what the other had. The lack of a standard measure of value and the need for a double coincidence of wants were major drawbacks. To solve the inefficiencies of barter, societies began using certain items as a medium of exchange. These were called commodity money. Items like salt, spices, tea, and cowrie shells were widely accepted. They had intrinsic value and could be stored or transported. However, these commodities had their issues. They were bulky, perishable, or limited to regional acceptance. Still, this was a major step toward formalizing the idea of value in trade. Around 600 BC, metal coins made their debut. Civilizations like the Lydians in modern-day Turkey were among the first to mint coins. These were made from valuable metals such as gold, silver, and copper, and stamped with symbols of authority. Coins were durable, portable, and had intrinsic value. They became standardized and were accepted over larger geographic regions. Governments began controlling the minting process, adding another layer of trust and stability to the system. This era saw the rise of centralized economies and the foundation of modern monetary policy. The concept of paper money originated in China during the Tang dynasty in the 7th century and became widespread during the Song dynasty in the 11th century. Merchants started using promissory notes as carrying coins became inconvenient. Europe followed centuries later, adopting paper currency in the 1600s. Unlike coins, paper money had no intrinsic value. Its worth depended on the trust placed in the issuing authority, usually a government or central bank. This shift marked a significant psychological change in how humans perceived money. It was no longer about the value of the material, but the belief in its purchasing power. As economies expanded, so did the need for safe storage and lending of money. Banks emerged as institutions that could store wealth, lend money, and facilitate trade through credit. They began issuing banknotes, essentially promises to pay the bearer a certain amount in gold or silver. This era saw the rise of the gold standard, where currencies were backed by a fixed amount of gold. It provided stability and predictability. However, this system was eventually abandoned due to economic crises and wars. Banks became powerful players in national and global economies, influencing policy, trade, and the financial health of nations. The 20th century brought in a digital revolution. Credit cards were introduced in the 1950s, making cashless transactions possible. By the 1970s and 80s, computers allowed banks to manage accounts and transactions digitally. ATMs, online banking, and electronic transfers became the norm. People no longer needed physical cash for every transaction. This laid the foundation for the digital economy we know today. This period also introduced the idea of money existing not in physical form, but as numbers on a screen, trusted and controlled by banks. As smartphones became widespread, mobile payments revolutionized everyday transactions. Apps like PayPal, Venmo, Alipay, and Apple Pay allowed users to send and receive money with just a few taps. fintech companies started challenging traditional banks by offering fast, easy, and secure financial services. The concept of decentralized finance began gaining attention, but something even more radical was brewing in the background. In 2009, an anonymous figure known as Satoshi Nakamoto introduced Bitcoin, a completely digital and decentralized currency. It was not controlled by any bank or government. Instead, it operated on a blockchain, a transparent and secure digital ledger. Bitcoin was revolutionary. It solved the problem of trust by using cryptography and decentralized consensus. People could now send money across the world without intermediaries. Since then, thousands of cryptocurrencies have emerged: Ethereum, Litecoin, Ripple, and more. While the world debates their stability and regulation, one thing is clear: cryptocurrency has changed how we think about money. From bartering goats to sending Bitcoin across continents, the evolution of currency is a story of innovation, trust, and transformation. As technology continues to evolve, so will our money. The question now is, what's next? If you liked this video, don't forget to like, share, and subscribe. Let us know in the comments what you think the future of money looks like.